Welcome to The Explainer. Okay, today we are tackling one of the most dramatic and honestly recurring stories in all of finance, the anatomy of a market bubble.
All right, let's just dive right in, shall we? I mean, with the absolute frenzy around artificial intelligence right now, there's this huge question hanging over everything. Are we witnessing a truly revolutionary new era, or are we just riding the wave of another historic bubble? Because, when you really look at the AI boom and you put it side by side with past manias, you start to see this familiar, almost predictable pattern emerge.
And this famous saying by Sir John Templeton, it just perfectly captures the life cycle we're going to dissect today. It's this incredible journey through human psychology, right? From fear all the way to greed. And that, right there, is the core anatomy of pretty much every single bubble we've ever seen in history.
Okay, so how does this whole thing even begin? Well, every single boom starts with a spark. It's some kind of disruptive new idea or a totally transformative technology that promises to, change the world. It's a story about the future, and man, is it a compelling one.
This financial innovation was an absolute game changer. Just think about it like this. Picture a ship captain back in the 1600s. He wants to sail to the East Indies. Now, that is an incredibly risky, super expensive voyage. He can't afford it on his own, no way. But what if he could sell shares in the voyage to a whole bunch of people? That's how he funds the trip. And if that ship comes back loaded with valuable spices, everyone who bought a share gets a cut of the profit. This simple idea, this is the engine that allows these massive, world-changing industries to get off the ground.
And this table, it just brilliantly illustrates how these new growth factors have been the fuel for market booms time and time again. I mean, during the Industrial Revolution, you couldn't just build a railroad with your own pocket money, right? It took massive amounts of capital, and that's what the stock market provided. Then you get to the Roaring '20s, the assembly line, the automobile, that created a whole new consumer economy. And of course, in the '90s, the internet promised to connect the entire globe. See the pattern? Each time, a powerful new story of growth completely captures the public's imagination. Okay, so let's move on to the next phase and see how this whole thing builds up steam. This is the point where rational excitement about a really promising future, it starts to bleed into something else, into irrational speculation. This is where the story, the narrative, starts to become more important than the actual reality. Now, this is an absolutely crucial concept. It taps right into our psychology. We humans, we are just wired for stories. And a really compelling narrative about the future can literally short-circuit the rational parts of our brain. Valuations start to completely detach from actual profits, all because investors are driven by that powerful fear of missing out, FOMO, right? They start to believe the future potential is limitless. At that point, you're not just buying a company, you're buying a piece of the future.
So, you might be wondering, how do we actually measure this detachment from reality? Well, one of the classic ways is something called the price-to-earnings ratio, or PE ratio. And get this, in September 1929, right before the Great Crash, the average PE for stocks hit 32.6. What does that mean? It means investors were willing to pay over $32 for every single dollar of a company's annual earnings. That is way, way above the historical average.
Okay, now fast forward to the peak of the dot-com bubble. It gets even more extreme. You had tons of internet companies, some with zero profits, that had PE ratios over 100. I mean, think about a company like Pets.com. The story was all about getting eyeballs on the website. That was it. And that story was enough to justify almost any price, even when the actual business model made absolutely no sense.
And this quote, this infamous quote, just perfectly captures the absolute peak of euphoria. And you have to remember, this was said by one of the most respected economists of his day, just weeks before the most devastating crash in history. It's the classic sign a bubble is reaching its breaking point, when people start to truly believe that the old rules no longer apply, that this time it's different. And that, of course, brings us to the final and most painful stage. See, when euphoria peaks, the bubble is at its most fragile. It's like a balloon stretched to its limit. It really doesn't take much. A little bit of bad news, a slight shift in sentiment, for that confidence to just shatter, triggering a sudden and violent collapse.
The Great Crash wasn't just a single day. It was this rapid, terrifying cascade of events. After the market peaked in September, it started to wobble. Then came Black Thursday, and pure panic set in. There was even this dramatic attempt by Wall Street's top bankers to prop up the market, but that only bought them a little time. By the following Tuesday, the floor just completely gave out. The market went into absolute freefall.
And the scale of the destruction was just staggering. From its peak in 1929 all the way down to its bottom in the summer of '32, the U.S. stock market lost nearly 90% of its value. 90%! Just to put that in perspective, it would take a full 25 years just to climb back to the level it was at before the crash.
And, we saw a really similar story, though maybe not quite as severe, after the dot-com bubble burst. The tech-heavy NASDAQ index that was home to all those high-flying internet stocks, it fell 78% from its peak in March 2000 down to its low in October 2002. Trillions in wealth just gone.
So look, the really crucial point here is understanding this pattern, right? The spark, the euphoria, and then the crash. Because we need to understand it to make sense of our own time. The big question is, does this history apply to what's happening right now?
And this brings us right to the heart of the debate today. So on one hand, the argument against this being a bubble is that the companies leading the AI boom are just fundamentally different from the dot-com era. I mean, these aren't just ideas on a napkin. They're some of the most profitable, cash-rich companies in the history of the world. But the counter-argument is that even for great companies, the price you pay still matters. And today's valuations, they seem to be pricing in decades of absolutely flawless growth, which, let's be honest, sounds a lot like the same kind of euphoria we've seen before.
So, what's the verdict? Are we in a brand new era of sustained, technology-driven growth where today's sky-high valuations actually make sense? Or is that echo of euphoria getting louder and louder, with a narrative that's once again running way ahead of reality? Well, that is the multi-trillion-dollar question to take away from this explainer.